What do you want when you retire? You want an income, you want it to be sustainable, even in the face of inflation, and you want that income to be as passive as possible, so you can spend your time doing whatever it is you want to do. Enter dividend investing, a strategy that can yield you an income of between 4 and 6% per year. That's money that's paid into your account on a quarterly basis with no action needed from you. And given that you're investing in profitable businesses that can increase their prices, that yield is likely to be very resistant to inflation. Dividend investing is not only good for income, it has also produced phenomenal total returns. The S&P 500 Dividend Aristocrats is a group of American companies that have increased their dividend every year for the last 25 years. And as you can see here, over the short term, whilst the S&P 500 has been plummeting, the aristocrats have held their ground. And if we go back to 2007, we can see that whilst the S&P 500 has returned 275%, the aristocrats returned 390%. What is not to love? This strategy appears to be the retiree's dream. But I would never recommend this to any of my clients, because dividend investing is an extremely lazy and inefficient strategy that appeals to our insecurities and biases. And in this video, I'm going to show you why that is and what you should be doing instead. Hello and welcome back to the channel. If you're new here, hi, my name is James. I am a financial planner, and this is a place where you can learn to make smarter financial decisions. Dividend investing is extremely popular, and it's easy to see why. You get a passive income, it's sustainable, and in the past it has produced market-beating returns, and I expect it to continue to do so in the future. So why then do I and fellow financial planners like Ben Felix advise our clients not to do this? Well, let's start with the basics and explain why dividends are not the free money people think they are. Here we have two companies, Company A and Company B. They are identical in every way. They have the same assets, revenue, and expected future earnings. The only difference is that Company A has a policy of paying a high dividend, typically around 5%. Given this information, as a retiree who is looking for income, which company would you rather invest in? Well, Company A is giving you a 5% income, whilst Company B isn't giving you anything. It's got to be A, right? Wrong. Let me explain. Let's say each company owns assets worth $100 per share. And to make things simple, let's assume that the share price matches the book value of those assets at $100 per share. Over the course of the next year, each company makes profits or earnings to the tune of $10 per share, which increases the company's assets to $110 per share. Company B decides to reinvest those profits back into its business, whilst Company A decides to pay out a dividend of $5 per share. And once that dividend is paid, what do you think would happen to its share price? Well, Company B still has assets worth $110, whilst Company A only has $105. This is the bit that people fail to recognize. When a company pays a dividend, it is returning cash to investors. Therefore, its assets and share price will fall by the amount of the dividend. In reality, when looking at a company's share price, it can be very hard to see this happening because there are so many other factors that influence a share price on a given day. And even though a company may be paying a 5% annual dividend, they often pay that out in quarterly installments. So the daily movement may only be 1.25%, which is easily obscured by the normal volatility of the share price. Dividends are not free money. The company is simply deciding to return your capital to you rather than keep it invested. It has the same effect as if the company directors had decided to sell some of your shares and return them to you. Because if you own shares in Company B and wanted an income of $5, you could create a homegrown dividend by selling down some of your shares to leave you with the equivalent of $105 worth of stock and $5 of cash. So let me ask you that question again. If you're looking for an income, which of these companies would you rather invest in? As you can see, it's irrelevant whether a company pays a dividend or not. We should value $5 of dividends exactly the same as $5 from a capital gain. But we don't. Part of us still prefers dividends, even though they're not as efficient. You see, with a dividend, your income is dictated by a group of company executives that have absolutely no regard for your financial plan. Whilst with homegrown dividends, you have control and can take the exact amount that you need when you need it. Yes, there may be trading costs involved, but it's also likely to be much more tax efficient. Generally, in most countries, dividends are taxed at higher rates than capital gains. If you're in the UK, you probably invest through tax-free wrappers like pensions or ISAs, so you might not think that you need to worry about tax. But that's not quite true, because there is one tax that these wrappers can't protect you from. If you receive a dividend from a foreign company, you often receive that dividend net of a withholding tax. If, for an example, you are based in the UK, investing in US stocks, any dividends that you receive will be paid net of a 30% withholding tax, even if you are invested in a pension or an ISA. However, this rate does drop to 15% if you have signed a W8 BEN form from your broker. So, as a side note, the next time you get an email from your broker bugging you to sign this, get on it. Whichever way you look at it, dividends are a very inefficient way of generating an income, and any rational investor should prefer homemade dividends, where you can sell down assets exactly as you need them. This is the rational thing to do, but barely anyone does. In a fascinating piece of research called the Decumulation Paradox, Why Aren't Retirees Spending More? They studied the drawdown strategies of US-based retirees, and they found that across all wealth levels, 58% of retirees draw down less than the income that their investments generate. 26% draw the exact amount of income that their portfolios earn, whilst only 14% draw down on the capital. So in any given year, only 1 in 7 retirees are actually selling down their assets to fund retirement. The rest are just living off the income. It's impossible to say what exactly is causing retirees to behave like this, but the research has concluded that instead of taking a top-down approach where you work out how much money you need to sustain your quality of life and then create a dynamic strategy to fund that, retirees are taking a bottom-up approach by first identifying their guaranteed and steady income sources and then just adjusting their lifestyles to fit within that budget. This is not a rational approach to retirement planning, and you'll probably end up working for way longer than you need to trying to supplement your income and then waste your precious, healthy retirement years being frugal when you should instead be enjoying your money. To a rational investor, the income a portfolio generates is irrelevant. The only thing that matters is the total return that is delivered by dividends and capital gains. And although dividends used to provide a very significant portion of the stock market's total return, 67% in the 1940s, 44% in the 1960s, and 73% in the 1970s, in recent decades, dividends now only make up a very small proportion of that overall total return, with the majority now being driven by capital gains. Dividends are irrelevant, but to the vast majority of investors, income is everything. So why are we so biased? Why are we programmed to think that company A is superior to company B? Well, as with most investing mistakes, it's all in your head. Mental accounting is a phenomenon whereby we spend money that has come from different sources in different ways. The classic example of this is how we often view bonuses or tax rebates as free money and spend them far more frivolously than money that we have earned through our normal salary. If you've got a 5k bonus, you're likely to spend it in a very different way than if you've got a 5k pay rise. This is irrational. Our perspective of money should not change depending on where it's come from. And we also see mental accounting in the way that we view income versus capital. In our minds, we have this ledger with income on one side and capital on the other. And we think that anything that falls into this income column can be spent freely, whilst anything in this capital column must never be touched. We think that income will keep flowing as long as we don't touch the capital. In a 2019 paper titled The Dividend Disconnect, they coined this the free dividend fallacy, where investors view dividends as free money and as a result value them more highly than capital gains, to the extent where investors are willing to pay more for dividend stocks like company A, even though there is no basis for doing so. But why does this happen? Why do we value income more highly? Mainly because we're lazy. With dividends, money just gets paid into your account every quarter and you just then learn to live by that income. But if you wanted to create an income from capital, you need to first work out how much income you need to sustain your lifestyle. You then need to assess whether it's sustainable to draw that level of income given current market conditions. You also need to decide what you're going to sell, when you're going to sell it, and when you finally do decide to sell, you will no doubt kick yourself as the market goes up right afterwards. It's a classic case of regret aversion and inertia bias. We chimps will do anything to avoid regressing decisions, so much so that we would rather not make any. We would rather outsource the decision making to somebody else, even if that someone is a company executive who sets the dividend policy who couldn't care less about our financial plans. I know this is true because I feel exactly the same way. My inner chimp would much rather somebody else decide what income is sustainable and just pay that money into my account each month. Screw having to make all these decisions which I might get wrong and regret. This is why we value dividends more highly than capital gains. But as you now know, there is no rational reason why you should prefer company A over company B. Whoa. Chill out. If dividends are irrelevant, then why is it that companies that pay higher dividends tend to outperform on a total return basis too? Good question. And let me explain this one with an analogy. Did you know that cars that are painted red are likely to be faster and have more horsepower than cars that are painted blue, or any other color for that matter? So if this was all the information that I had and I was looking to buy a fast car, it's understandable that I might think that I should be looking for a red car, right? But anyone with any knowledge of cars knows that it's not the paint color that makes a car fast. It just so happens that red is associated with a lot of sports car brands and favored by people that drive fast cars. So if I went on Auto Trader and picked a random red car, yes, it's likely that it would be faster than average, but not all fast cars are red, and not all red cars are fast. So by filtering for just red cars, I'm limiting myself to a small corner of the market, and there's still a high chance that I could pick a dud. Instead, I would have much more success if I filtered by the characteristics that actually contribute to a car's performance, like perhaps its make or the size of its engine. I hope you're starting to see my point. Historically, companies that pay high dividends have outperformed companies that don't. But the dividend is not the reason that these companies outperform. Just like the red paint, dividends are just a symptom of the underlying characteristics or factors that really lead to outperformance. In a 2014 paper, Eugene Fama and Kenneth French identified that over the long term, companies with lower valuations compared with their book price tend to outperform companies with high valuations. Smaller companies tend to outperform big companies, more profitable companies tend to outperform less profitable ones, and companies that invest conservatively tend to outperform ones that invest aggressively. These are the actual factors that drive outperformance. It just so happens that companies that are highly profitable and invest conservatively are more likely to pay a dividend, and that dividend is going to look much higher if their valuations are low. And Fama and French use their model to demonstrate that 95% of dividend stocks' outperformance can be explained by their exposure to these factors. So yes, if you want to try and outperform the market, you could build a portfolio entirely made up of dividend stocks, but you would be restricting yourself to a small corner of the market, which would reduce your diversification and leave you heavily exposed to certain sectors like finance and energy, and underexposed to smaller companies. A much more efficient way to do this would be to ignore dividends entirely and instead build a portfolio that selects for these factors in the first place. This is known as factor investing. It's how I invest my money and my clients' money. And if it's something that you want to learn more about to decide whether it's something that's right for you, then you should watch this video here. I'll see you there.